Trading IPO breakouts. So IPO, initial public offering. This is when a stock is first traded. So we're going to go over some ground rules. Never, under any circumstance, buy a stock on the day it IPOs. There's not enough data. It's too volatile. We never, ever, ever, under any circumstance, buy a stock on the day it IPOs. We gotta wait for it to consolidate sideways or down for at least 2 or 3 weeks. Sometimes you can get away with 1 week, but ideally I want 2 or 3 weeks. We're gonna buy as the stock makes a new high. So ideally what we want to happen is the stock IPOs, it comes down or goes sideways for a little bit. 2 to 3 weeks at least I would prefer. Sometimes I'll go as low as a week if I really, really like it. But ideally, I want around 2 or 3 weeks of sideways or downward action, and then we're going to buy it as it makes a new high. IPOs are tricky because there's not going to be 50 days worth of trading data. So you're not going to have a 50-day average volume. You're going to have to use a 20-day or even 10-day average volume. And the volume is going to have to be up when it makes a new high. The 50-day moving average is probably not going to be available either. So you're going to have to just use the chart and look for a recent area of support to put your stop under. You can also try to use the 20-day moving average as a trailing stop, but sometimes that's going to knock you out a little bit too early. If you were going to use the 20-day moving average, then you'd say when the 20-day moving average is above your buy point, use that as a trailing stop instead of your initial stop. Most of the time, you're going to eventually get the 50-day in there, and then you're going to want to use the 50-day or the 100-day as they appear. But if you really want to use a trailing stop, you could use the 20-day instead. I personally use my initial stop, and then I'm going to wait for the 50-day to appear and then use the 50-day as a trailing stop. I would only use the 20-day as a trailing stop if the stock was way extended and there was no 50-day, and then it fell drastically through the 20-day. Then I would sell it. But in most cases, you're going to see in the examples, it's going to be a lot clearer in the examples. In most cases, eventually you get the 50-day and use your 50-day as a trailing stop or the 100-day as a trailing stop. So let's look at some instances why you do not buy on the initial public offering day, the IPO day. So here's Lyft here in 2019. You see Lyft IPOs here. So sometimes people, they say, oh, I know Lyft, it's innovative, let me buy Lyft on the first day. They buy it on the first day and they buy it, let's say, at 80, and then before they know it, it's down to 50, and then it rallies a little bit to 60. So you don't want to buy on this initial public offering day here. It's too much risk, and you don't know what's going to happen. And we need a little bit more time for a chart to set up. QTT, you see the first day, very volatile, all the way up here from 10 to 21. Then the next day collapses like this and then heads downward all the way down here to $4 or so. So this is why I try to avoid buying stocks the first few days after the IPO. The IPO day, I'm definitely not going to buy it on, and the next day, I don't want anything a part of it. You see, this is way too volatile. So that's why we like to wait a few days, and in most cases, a few weeks. Facebook IPO. A lot of people got burned on this. Facebook, a real innovative company. Everybody uses it. Game changer, changed the way we communicate with people. You see the IPO day here, ran up to 45, and then by June, it's all the way down to 26. And unfortunately for a lot of people, they bought it up here and they wound up selling it down here. I remember going on Facebook in 2012 and people writing on Facebook how they got in Facebook stock on the first day. And those are people who are probably not really very passionate about the stock market and just trying to get in, and then before they know it, they're at a loss, and somebody like that's going to be selling it down here. I covered the Facebook trade from 2013 much more in depth in the section on gaps, and then in that section I show you how to buy Facebook, how you should have bought Facebook, I said, in 2013. Because this was a stock in 2012 it IPO'd, and the real buy point was in, I think it was June or July of 2013. I know it was 2013. I forget if it was June or July, but it took a long time. A lot of people got frustrated, built a big, huge cup and handle, and gapped up, I think, 29%. But anyway, if you want to see more about how to play Facebook for the IPO in 2013, IPO in 2012, I should say, you're going to look at the section on gaps. Okay, Dropbox. This is one I took. and you see here it consolidated sideways here, and it had this big huge volume here. So I didn't buy on these days, and I waited for it to consolidate a little bit, and I bought it here, and then I just got stopped out. So this is part of trading. This was a perfectly valid setup here. IPO here, I gave it some time, nice sideways action, big volume coming in. I bought it here, and unfortunately I got stopped out. It's part of trading. Things like that happen. Now we're going to start getting into some of the big winners that were IPOs. So let's look at Google. Okay, this is Google in 2004. So you see here's the IPO here, okay, and we have the second day and the third day. I'm not getting involved in an IPO in these days like this, and this is the reason why. I want to see some sort of consolidation here. So Google goes up, forms a little bit of a U, and then we're going to buy it when the high of this day is taken out. Now, sometimes I say the high of the IPO day, but in this case, I wanted to wait the first few days, so I wait for the high of for a new all-time high to be made, a closing new high. So here's, you see it closes here above this price here, and that's going to be the buy day. And what I like about the chart here, you see there's very little selling in here. There's really no selling, and it's very, very calm. So we're going to buy on a close above this price here. It goes up, it makes a high. We will let it consolidate a little bit, almost like a U, and then we're going to buy on the close above here, which is here. So we're buying around $57 here. Here's the weekly chart. You can see the weekly chart. First week up, goes down a little bit, almost like a U. Not really much huge volume here, nice and quiet, and boom, 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 up. And you could see this is the buy price down here, and it goes all the way up to 100. Okay, so at this point, there's no 50-day moving average. So at this point, it's a little tricky to figure out what to do. If Google were to collapse here very quickly, let's say down here, you could try to get out with a 20-day moving average here. I didn't put that on the chart because it ran up so quickly, but after the 50-day appears, you're going to sell on a close below the 50-day if you're a 50-day trader. So the 50-day traders would be stopped out here. If you're somebody who really, really wants to give stock more room, you're going to wait for a close below 100-day here. And you see it does hold here. It comes down intraday, but then it closes above the 100-day, and then it heads higher again. So it's really a matter of personal preference. Some people, they buy it here, and then you could sell it up here, and this is probably like a 5-hour trade or so if you sell it up here. So that's one way you could do it, is if you're a person who wants profit targets, you could say you're going to sell at 5-hour, and then if you don't get out there, you would sell out on a close below the 50-day, which is right in here. You still make a good chunk of money here from here to here. And if you're somebody who really doesn't want to do a lot of trading and wants to hold the stock longer, you're going to wait for a close below the 100-day. And you see it doesn't close below the 100-day. It comes right down and comes right back up. This instance here is why I used the 100-day. I tried a lot of different moving averages. I tried the 65-day moving average. I tried the 200-day. The problem with the 200-day, it's too far away. And I tried the 20-day, I felt that got me out too quick. So I felt the 100-day, a lot of times it was holding on stuff like this where I used to get stopped out of the 50-day. So you see the 100-day holds. Intraday, it's down. We wait for a close. It closes above the 100-day, and then it's back up again. So if you're a 100-day trader, if you're someone who's waiting for a close below 100-day, you're still in trade. Now you see here, this is the candle I was talking about from the last chart. Goes down intraday and closes just above the 100-day here. You see buyers came in and they pushed it back up. And then you see if you sold it in here below the 50-day, you're going to try to buy it back. You could try to buy it back in here. These are advanced buys here. These are very advanced to try to buy it here. Or you're going to try to buy these gap day. Now, I covered this in the gap section, so I'm not going to go through this too deep in this course. But if you sold it over here on the close below the 50-day, you're going to try to get back in. Now, these would be advanced to buy here, or you're going to try to do a gap buy up here. And if you're a 100-day trader who sells on the close below 100-day, you're still in trade. So if you sold it down here, here's your rebuy point. Here it gaps up high, and you buy here as the high of the gap is taken out, and there's a close above. This is covered much further in the gap section of the course. But I just wanted to reference it again here to show you that if you get out of a stock, you can sometimes get back in. And if you held it as it found support on the 100-day, you're still in it here. So you see, this is just a true monster stock. It just up and up and up and up and up, goes all the way up to 240, and finally a close below the 100-day. So if you were somebody who bought this, let's go back a few. If you were somebody who bought it here at 57 and you said, you know what, Google's on a big run up and you're watching it pull back here and it doesn't close below the 50-day, and here it closes below the 50-day, and you say, you know what, I'm going to wait for it to close below 100-day. Now that takes a lot of guts because you're going to have to sit through some pullbacks and stuff, and this day is going to drive you crazy. But if you were disciplined and said, I'm going to wait for it to close below the 100-day, you buy it at 57 and you sell it at 192, over a triple of your initial investment. So that is a great trade. And this shows you what happens when you get yourself into a monster stock, especially a monster stock that's an innovative stock, that's especially well known, that's a game changer. You see all the things that can happen here. Amazing trade. Here's Baidu. It IPO'd in 2005, and this is a chart from February 2006, and I want to show you what happens here. Huge first day, monster first day, and then it just meanders down all the way down to $4.92 over the coming months. So this is why we don't get too excited on the first day. Crazy things can happen. So this is why it's important to wait a few days. Snap. A lot of people know Snapchat. They thought, oh, it's going to be the next monster stock. You see what happened. First few days were great, all the way up to around, let's say, 28, 29. Before you know it, it's selling at $12. So this is why we wait a few days before we buy the IPO. Twitter. Okay, Twitter, this looks a little similar to the Google chart we showed earlier. It goes up on the IPO day, makes a little bit of a U, and you're going to buy it on this day when it clears this. So here's the high, it clears it here, and nice low volume in here, and then this heads higher here on good volume. So I like that. I like the low volume here and the high volume here as it makes a new high and it closes above here. You'd buy it over here, and you put your stop maybe down here. If you want to be a little bit more risky, you put your stop around here. But if you want to be conservative, you put it here. So either here or up here, you can put your stop. And you see what happens here. Twitter really runs up pretty good. And then when it does close below the 50-day, it's on a 24% down day. So this would be a trade where you probably get out maybe a break even or maybe a slight loss. The reason why I'm showing this, I want you to see that anything can happen. You know, sometimes people make courses like this or they make videos and they don't show you examples like this. I'm trying to show you that anything can happen in the stock market. Nothing is perfect, and things like this happen. So this was an instance where Twitter looked great, and all of a sudden it just collapsed. Sometimes stuff like that happens. Let's look at ACIA. You see here, very similar to the Google chart. Big volume on the IPO day, almost makes like a little bit of a U. And I love the low selling in here, the very low volume as it consolidates. Not much selling, shows people are still in the mindset of holding it. Makes a new high on this day, May 23rd, 2016, on high volume, close above the high of the IPO day. And if you were in this stock here and you're buying it on this day, you could either put your stop loss maybe below the low this day here, I guess around 29.40, I'd say. Give it a little extra room, or you could put it down at 29. Another option would be to put it around 28 to give it even more room. So it's a matter of personal preference how conservative you want to be. So you see here's the buy point here, and I put the 20-day and the 50-day in this chart because I wanted to show you a few things. This is why I don't really use the 20-day too often. You see the 20-day knocks you out quick. So I wanted to show in this example how using the 50-day really keeps you in the trade longer here. So you see this one runs up from 30 all the way up to 130. So if you're somebody who's going for 5R, you're probably selling it here. You probably get 10R or so up here. And then if you were selling on a close below the 20-day, it gets you out too soon. So that's why we would use the 50-day, which would get you out here. So this is a trade you can make a lot of money up here selling into strength. And then if you want to hold it as long as it's above the 50-day, you still make a lot of money and you sell it in here. Let's look at the next one. Amazon IPO here. You see here's the cup and here's the handle. Look at this nice low volume here in the handle, big volume here on the right side, and nice low volume here along the lows. Excellent chart. Look at this, up 47% in 1 week, my gosh. So here's the chart here, big cup here, and a huge volume here on the right side, and nice low volume here in the handle here. You could buy it on this day here. This is a cheat buy here. You would buy it when this area is cleared and you put your stop down here. That's a cheat buy. It's more advanced. You could try that. The other thing you could do is, this is not really a breakout here yet. Taking out this point is the breakout. This one here is only taking out this one. So this is still a little bit of a cheat, since this high was not taken out yet. But you could buy on one of those days and it still would work. It's just a little bit more risky. Let's look at the next chart. You see, this is the day where it's really the time to buy it. When you see this, it takes out this point here. And then you put your stop down here at $2.22. This is going to be a monster chart when you look at it. But you see the big cup, and here's the handle and the breakout. And you're going to see this really runs up big. So it runs up all the way from $3 here all the way to $4.50. And it holds here. There's a close below the 50-day, but you see the 100-day holds. There's a close below the 50-day here, which you still would make a good trade if you a lot of money, I should say, if you waited for a close below the 50-day here. And you see the red, the 20-day doesn't really keep you in. So that's why I don't really use the 20-day too often. I prefer to use the 50-day or the 100-day. 50-day, you get the close here. You get out the 100-day, keeps you in the trade. This is why the 100-day is great to use if you're a longer-term trader. And before you know it, it's at $6.96. Now, you buy a stock at $3 here. Now, just as an aside, Amazon's had stock splits. It wasn't really at $3, but it's $3 on the chart here due to the stock split. So $3 here, before you net more than a double, almost $7 here. Wow. And still no closes below the 100-day. If you sold it, you could try to re-enter it here. So sometimes you get another re-entry. I love how the 100-day never breaks. It holds. You could try to re-enter it here if you sold it. I guess you would have sold it in here when the 50-day, in here. You sold it here when the 50-day is lost. See, this is a support day. It just holds these 2 days. This day you get out, you'd have to buy it in here, and then you see this is a monster all the way up to here to 22.92. And what I like here about here is you see it consolidates here. Nice low quiet volume, and you see all the big gray volume here. A lot of buying here in Amazon in 1998. And here was a chart from 1998 as well. You see, here's the section over here. Here's this section here. We're going to look at the weekly chart of that. Nice quiet action in here. Nice consolidation here. Tight closes, tiny bars. Tight closes here. Boom on big volume. That's another buy point. So if you didn't get this buy point, or you didn't get a buy point here, you can try to get this one here. It runs up huge, and when you see something like this, you can go for 3R, maybe you can even get 6, 7R. You can try to get out. If you don't get out, if you don't like to sell into strength, you can sell in a close below the 50-day here. Or if you still want to give it room, you sell in a close below the 100-day. The negative part of the 100-day is sometimes you give up some of your gains waiting for a pullback. So sometimes the 100-day keeps you in. You see the 100-day keeps you in the trade here? 100-day keeps you in the trade here. Here, if you're waiting for a close below the 100-day, a lot of your losses, a lot of your gains get lost here. So it's a matter of give and take. Either way, this is a monster trade here. Buying it from $3 here all the way up to, at the worst case scenario, if you're selling it here, $14. You're making 7 times. Five. I'm sorry, my math is terrible. So you're still making 5 times your money here if you're selling here. But this is a very rare stock. Amazon True Innovator. And it had been a recent IPO. So this is why we do the studies, to see how to play these things when future trades come up. Lessons. You got to wait for a proper setup before buying. We don't buy on the IPO day. We wait for the chart to consolidate and set up in a pattern. Also, I want to point out again, Amazon was really not a $2 stock. This is just adjusted prices from all the stock splits. The 100-day keeps you in the trade. If you're saying, I'm going to wait for a close below the 100-day, it keeps you in the trade for a long time. You give up some of your gains at the end, but it kept you in the trade for a lot of the gains. So you got to say no system is perfect. It's all part of trading. Sometimes you sell for 3 or 4R, and you say, oh, wow, I could have had 15R. Sometimes you go for 15R, and you wind up with 7R. It's all part of trading. No system's perfect. But if you're in a monster stock, and it's a recent IPO, you want to give it some room to run, especially if it's shown a lot of strength like Amazon did here. Here's eBay. eBay, it pays to wait off here. If you're trying to buy it on this day here, you see you get yourself into a headache here, all the way going down, it cuts in half. So this is why we wait a little bit. They get very volatile. Now this is where it gets scary here with eBay. Up 46% in one day. This is insane, right? So I probably wouldn't buy this because this is a crazy gap up. So what I would do is wait for get a little consolidation here and then buy on this day here. And then I put my stop loss here where the red is. This is a very advanced buy. But the thing that makes me so bullish about a stock in this situation is the volume. You see here, no selling in here. Here, huge volume on the way up and then no selling. See, really no selling in here and then huge volume here. So even though it looks, wow, this stock is way extended, it's worth the risk because it could run even higher. Something's going on here that it's getting all this volume and no selling. So here's a weekly chart. And you can see what happens here. Here's the day we would buy it. Runs all the way up to $5.50. And here you get a close below the 50-day here. So it's more than a double here if you sell it at $3 here. So just a real monster stock. This was what we were getting in late 98 with eBay. Lessons. Waiting on this IPO gets you a better entry. You buy in the IPO day. It cuts in half right afterwards. There's the huge gap up, which those gap ups can be tricky. I covered this more in the gap up section. But the gap up here was actually a sign of strength. And the volume tells the story. The big volume coming in with no selling. And a huge gap up like this at the beginning of the move can be a sign of strength. But a huge gap up after a stock has already run up a large amount can be a sign of topping. So it's really, that's where your chart skills come in. And also it's important to note IPOs in companies that you know that are innovators can really be very profitable if you play them correctly. Okay, so here's First Solar here. You see, here's the IPO week, runs up. And in this consolidation here, it's not as neat and orderly as I'd like it to be, but what I like is the low volume. When you see something run up like this on the big volume and then the low volume consolidation, that's a great sign of strength. Let's look at the daily chart here. So this is an instance where you could have made more money buying on the IPO day, but I still don't like this buy because I don't know that this is going to happen. Right? How could I know on this day that this is going to happen? So I still like to have the chart, have some data to see. This is not a perfect pattern, but this is important to study. This is why we go back and do these back tests and look at these charts so we can study and be prepared for the future. It's not a perfect chart here, but you see it does make a new high after this consolidation here. If you buy here, you see First Solar goes on a crazy run here. And if you say, I'm going to wait for a close below the 50-day, you sell here, you still make a nice profit here. Now, I like to use the 100-day if it's a really powerful stock and give it more room to run. You see it doesn't even approach the 100-day. It goes way higher. So 50-day traders, if you're selling a close below the 50-day, you're selling it here. It goes way higher. Look at this, all the way up to 125. Now, this is the fascinating part to me. You see this big hammer candle here? It goes down intraday and it comes right back up. So this is why we wait for a close below the 100-day, because intraday it does come down and it drives right back up and closes above the 100-day. So you'd stay in the trade. Watch this. It comes back up. So here's the hammer here, goes down intraday and comes right back up. And this took a lot of guts to sit through this. And I mean, I wasn't trading back at this point here, but anybody who held it through here had a lot of guts to watch it go from here to here. But you see intraday, it goes down and comes right back up. And before you know it, it's back at 97. So this the important point that I want you to see is we wait for a close below 100-day, because see the hammer candle keeps us in. And look at this. Here's the hammer, and it closes right above the 100-day. You see these moving averages. This is not a coincidence. People, they trade off these things. They drove it right back above the 100-day, and then before you know it, it's at 126. You could try to buy it back here. If you sold it here, you could try to buy it back here. This is why I don't always use the 50-day if it's a very strong stock, because stuff like this used to happen to me a lot. I'd sell on a close below the 50-day, and then before I know it, it'd be heading way higher without me. So that's why I started using the 100-day for some of the stocks that I really like it. I'll use the 50-day if it's a stock where I feel okay about it. If it's a stock I feel okay about it, I go for maybe 3R, and I'll use the 50-day as a trailing stop. If I really like the stock, if it's very powerful, if I'm making a lot of money, I'll give it more room to run, and I'll use the 100-day. So if you sold it down here, you could try to buy it back here. It's a little trickier, but you still could do it. I like the big volume coming in here. You see this thing goes to 266,000. This is a monster. It doubles from this point. From this point here, it doubles to 266. I mean, this is insane. This is an insane situation from 2007. But you think about it, First Solar, solar energy, innovator, right? Recent IPO. They have the potential to really double. And here's the weekly chart. So here we're buying it down here, and oh boy, all the way up to here, 126. This would be the point where you're buying it. So this is this point here. This is the weekly chart here, buying it. And you see it runs way up, and finally you get a close below the 100-day. Now you have to sit from 280 all the way to, let's say, 180. So that's a big loss here. But that's part of trading, and you still made 4 times your money. So no system's going to be perfect. People who say, you really should have sold it at 280, those people would have thought that this was the top, right? So it's tricky. You never know where the top is. Or they would have thought this was the top. So you never know where the top is. And that's why I use the 100-day if I really, really like the stock. Sure, sometimes you see some of these things pull back hard, and then you lose some of your gains. But it kept you in a great trade. And this is a trade you make 4 times your money, because if you buy it on here, let's go all the way back. If you buy it here at 31.14, and now you're selling it at 175, that's a great gain. That's a great gain. So you see, First Solar was a true monster stock coming out of the IPO. We never sell at the exact top, but we do capture a lot of gains. And this is tough when you sit through something like this, but it's just part of trading. If you wanted the money to be so flat and not fluctuate at all, you just got to put your money in a certificate of deposit. So it's very difficult to figure out where the top is going to be exactly. But the 100-day keeps us in the trade, and this was still a great winner. Even if you sell it on here, you still had a great gain, because you bought it at 31 and you're selling it in here. So it's still a great gain. And then you see after it loses the 100-day, it's just sort of meandering around, and you don't really want to be in this, because this is just dead money at this point. Why should you waste your time and energy on it? So what were some lessons we learned from the First Solar trade? Huge money, truly huge money, can be made if you play an IPO correctly. Remember, we wait. We don't buy right away. And it's got to be an innovative company, a game changer, right? Solar energy, a game changer. And you're going to wait for a close below the 100-day. If it's an extremely powerful stock, wait for a close below the 100-day. If it's not extremely powerful, you can sell in a close below the 50-day. If you're a shorter-term trader, you sell in a close below the 50-day, and you look to buy the next time it breaks out. Sometimes you get another chance, sometimes you don't. You really got to think about your personal preferences. If you're somebody who wants to do shorter-term trading, you go for 3R or sell on a close below the 50-day. And if you want to do less trading and hold the stock longer, wait for a close below the 100-day if it's an extremely powerful stock. Like I said earlier, if the stock's not extremely powerful, I'll use the 50-day as a trailing stop. But in this instance, you see, First Solar was an absolute monster. And the other thing I wanted you to take away from this section was, you don't have to sell at the exact top to make big profits. The key is just to capture the bulk of the trend.